Hi, let's find out the difference today between a business that is self-funded or what is now commonly called as bootstrapped and a business which requires external capital or money from investors to become a larger business. Also, we'll find out whether your business needs to go for an external fundraise or not. So before we begin, let's first understand and define a startup. A startup is a service or a product which has some sense of novelty about it. So the novelty could be in the form of technology, it could be in the form of intellectual property, it could be about customer segmentation, brand positioning, your approach to marketing, your approach to distribution, but essentially some sense of novelty which can help that business or that upstart become a larger business in a shorter time span with or without the use of capital. Now, what's a bootstrap business? A bootstrap business is essentially an upstart, a startup, or a business that you're hoping to form, which is self-funded, which means that you've either infused some amount of capital of your own, or maybe in some cases have borrowed some capital from friends and family to really launch a product or a service, and then you hope to generate revenue from that product or service, which will essentially give you profits, which you can again funnel back into the business. So again, simply put, a bootstrap business is a business which you start and you hope to generate revenue or sales from, and those sales and revenue will translate into profits, which you can again, after meeting your expenses, churn back into the business and hope to grow that business. So as you can understand, since you're not raising external capital, you only have a limited amount of money that you can infuse into this business, or initially you can only generate a certain amount of revenue from your customers, which means that this business would inherently grow slightly slower because you will not be able to spend too much money on marketing, you will not be able to spend too much money on distribution, on giving discounts, because you have to generate revenue and profits from every unit or every service that you sell or deliver. And that is what makes a bootstrap business, in most cases, a business which is slow to scale. Now, yes, you do have some bootstrap businesses like Zerodha, which could use technology and really scale fast. But that was because that technology enabled them to amass a giant set of users and then generate revenue from that users, because that business inherently had a very, very strong monetizable business model. But typically speaking, a business that is bootstrapped or self-funded will take a certain amount of time to grow, because you have to keep generating revenue and keep funneling in those profits into that business to make it a larger business over a period of time. To put a time frame into it, a bootstrap business to reach a certain optimal state or a critical mass usually takes anywhere between 5 to even 20 to 25 years. So what's a funded business? A funded business is a business for which you basically raise capital from investors, whether angel investors, private equity investors, venture capitalists. You raise money from financial institutions, and there are many, many modes of financing that you can do. But essentially, this business either requires capital to first and foremost set up the business, which could be in the case of, let's say, a factory, which is a capital heavy business where you need to buy land, buy equipment, machinery, and then really set that up. Or it could be a business for which you require discounting to consumers. You're trying to break into a market where there are already existing players, and you need to use that discounting to give your product or service at a cheaper price, so consumers can essentially use that product or service and then eventually realize they want that and then start paying the fair price for it. So a business which is a funded business requires certain amount of capital for it to become a business in the first place and then eventually become a larger business. Now, does your business require external capital? This is not a very simple answer. It has many nuances to this. But a couple of key thumb rules can help you decide whether your business requires you to raise external capital. Firstly, it really boils down to you, whether you are in the business of making a business in a short span of time. Many people, in fact, a majority of businesses that exist are actually businesses that have been built over a period of decades. And that means that they've been bootstrapped, they've maybe raised a certain amount of financing, and then over a period of time, over decades, they've grown, they've compounded, and eventually become large businesses. So that's the first call you have to take, because when you go into a funded business, you must remember that you've taken money from investors who are looking for multiples or a many-fold increase on their investment. And that means that you have to grow that business really fast. You have to keep spending money and you have to make it a giant business. You cannot make it just a lifestyle business. So whether your business requires capital or external capital really boils down to a few couple of factors. The first and foremost is actually whether you want to be a part of a business which requires money from investors, which means that you have to first raise that capital, excite investors for them to see the opportunity you have large enough for them to get returns on their capital invested, and then you have to give that return in a certain period of time, which could be about 5 to 10 years, which basically means that you cannot build that business leisurely over a period of decades, and it's less than a lifestyle business. It's a business which needs to grow really fast so that it can become a larger business over a shorter period of time. Now, whether your business actually requires capital or could use capital, let's understand through an example. We've all used online grocery companies, whether it's Swiggy's Instamart, Blinkit by Zomato, there is Zepto, there's actually offline players like Spencer's and D-Mart and many other companies providing services. Now, how would you actually break into that market? First and foremost, you would have to build a technology platform, which requires a lot of money. You would have to build out a certain customer base or an audience which would actually try your service and product. And why would they do that? Only if you're actually providing them discounts or some value proposition which no one else is providing. You actually have to build out the delivery logistics network, which is quite expensive, honestly, and only makes money once you have a certain scale. So to start an online grocery company in today's world, you need a lot of capital, and you need to grow that business really fast so that you can continuously keep raising capital from investors and then becoming as large as other existing players out there, because that business with its low gross margins, etc., will only make sense at that kind of scale. And hence, to start a business in a very competitive space, you will require a lot of capital because you are competing against incumbents. Let's also try to understand this concept through a more conventional business. Let's say you want to start a brand of chocolates. Now, to actually acquire customers who will purchase chocolates from you, whether you list on any of these platforms, you have to create a brand. Because unless you're able to create that brand and that awareness, how is someone going to know you exist, and why would they actually try out your chocolate? And especially when you're in a market which has companies like ITC, who will ensure and who will try to do whatever they can to not let their customers switch over to your brand, which means deep discounting, in some cases legal approaches, and of course use the power of their distribution, wherein they ensure that all their products are stocked everywhere such that consumers can only witness their product on shelves. So to build out this brand of chocolates, you will actually first have to create a brand positioning, you will have to spread the word out there, you will probably have to deep discount, and then eventually ensure that your consumers like your product so that they can continuously and repeatedly switch over from other brands. Now, the whole point of giving these two examples was to try to explain the concept of market dynamics, which means that market dynamics essentially define whether your business has the luxury of just generating profits and then funneling that into the business, whether your business actually does not need to grow really fast, or whether your business is in a market where you need to raise capital so you can discount, so you can build a presence, you can actually go to market, build out distribution, or your business is in a market which has so much competition that to fend off that competition, you will need to keep raising capital, which also means that you can probably become a large business in a shorter span of time. Now, these dynamics are what decide whether you should, for your business, go in for an external fundraise or not. And net, it really boils down to the kind of choice that you want, the kind of businesses that you're hoping to build, and whether you want to build that significant and that larger business over a shorter period of time. So bottom line, it boils down to a couple of key aspects. One is, of course, your personal ambition. Whether you're looking to build a lifestyle business which you and your family could run for generations, or whether you are looking at building a business over a short span of time and a very large business that is. Number two, the market dynamics. And those market dynamics are extremely important because based on the kind of market dynamics that exist in your industry, you would have to take steps to either fend off competition or to grow in that certain market. And of course, lastly, your business and your business model. Whether your business is something which requires even a limited amount of capital because it's just a high gross margin business and you can actually keep funneling in your profits and eventually become a significant player. Or whether your business works on thin gross margin stacks and really waits for a certain kind of distribution or a consumer base or a critical mass to form over a certain period of time, after which you can start monetizing.